Well, good morning and welcome back to the Broadcast Retirement Network's BRN Sunday podcast. Hope you had a great week. I'm Jeff Snyder, your host, and I'm going to be joined today by members of the media, academia, and financial services and as we analyze all the news in retirement markets, technology, personal finance, so much more. So glad you could join us. We've got a jam-packed show as usual for you, so sit back and relax and enjoy this episode of the BRN Sunday podcast. We're going to kick things off with technology, and joining me on the line, the Motley Fool's Dan Klein. Hey, Dan, how are you?
Hey, Jeff, how are you?
I'm doing quite well. You had a good week?
The weeks all blend into each other, but yes, I went to a casino in North Carolina over the weekend, which was a 12-hour drive, but a lovely experience.
That's right. You did say you're doing that. So how was the weather was nice, the scenery was good to look at?
It's a pretty drive, though I don't recommend a 12-hour drive to anyone, and my air conditioning decided on the way home about 6 hours in that it wasn't going to work anymore.
No.
But I was amazed at how people operated in the casino. They put their masks on. They did everything correctly.
That's good. Well, there is hope. There is hope. So, Dan, I want to jump into this Twitter hack that I know you had been covering and looking at, and really interesting. I guess maybe we start with some of the basics around this thing because it impacts so many great figures, but very notable figures that were impacted by this.
Yeah, it was more the extent of it. Everyone from Kanye West to Barack Obama to Elon Musk got hacked, and Twitter basically had to shut down any accounts that were verified. So the people that have the little blue check next to it. But it's more important what the hack was. This wasn't like someone who went into the Barack Obama account and started putting, pro-Trump stuff. They were actually touting a Bitcoin property. So this is one where across a wide spread of celebrities who do not politically agree, who are not always on the same page, all of their accounts were touting this Bitcoin property that promised to double your money.
Oh, gosh.
Now, I feel like you need to have a little bit of skepticism. Like if you see something a little bit wacky on Kanye West's account, okay, it's not crazy to believe that Kanye West might be paid to promote some cryptocurrency. Maybe the same thing with Elon Musk. He has some odd tweets, but it feels weird to me that you'd believe that Obama or some of the other more credible people here were all of a sudden touting cryptocurrency.
So, Dan, I guess there's a couple things that I want to unpack here. One is the hacking part, and the second part, which we've talked on and on about on this network, about credible news sources and what to believe, what not to believe. So let's start with the hack itself. Do we know anything about the who, the what, the where, how this was happening? Because you said they're all on different ends of the political, social spectrum, right? So it's not just one party or one group. Any ideas what kind of how this happened?
Sadly, no. But this broke late yesterday. I'm guessing Twitter has some ideas, but we don't know yet. And this is one of those scenarios where a lot of times a hack is for, let's call it fun.
Yeah.
Or maybe it's for
Enrichment.
well, this was a clear case of enrichment. They were touting something, and this was basically a financial scam. So it's one of those scenarios where you have to be really careful. Like, should you be buying anything? Like, okay, if Kanye West touts a sweater and you can go buy that sweater on Macy's, well, that makes sense. But if somebody's promoting something and where you give your money isn't something you've heard of, that sounds like an awful, awful idea.
Yeah, I think you're right. And I think the larger issue here, I think the hack, as I said, important for cybersecurity protection, making sure people's accounts are not violated in any way, your privacy is not violated. But I think the larger issue, and especially when it comes to financial news, and we have talked about this, as I said, a lot on the network and on the podcast, and it's very important to understand the rationale as to why someone is promoting something. And I think you said this on the network either last week or the previous week. So the why someone is promoting it, you got to ask yourself that. And then you got to take the sniff test and say, does this actually make sense? And you made the point, can you really double your money? I mean, that in itself just sounds like a and I don't want to knock used car salesmen because I think that, or car salesmen people in general, because I think they have a very valuable role to play. But it just sounds like what you traditionally know as a used car salesman, like step right up, and we're going to get you this and that. I
Yeah.
mean, you have to ask those questions.
I mean, look, I work for a company that sometimes uses, let's call it aggressive marketing. It's something we've talked about as a company phasing down. But if you see an ad that says this stock has 10 times your money, and then you go to a page and it's the Motley Fool, and you do your research on the Motley Fool, and you realize, okay, this marketing claim is true. Maybe the context of it isn't great, but this company is credible. You have to do that extra step of work. But Motley Fool is a brand a lot of people have heard of. If the brand is my friends, I have some friends that started a stock picking service called Seven Investing. Well, they're not as well known. So you have to go a lot deeper. Maybe you read their LinkedIn pages and you go, okay, Simon Erickson, the CEO of Seven Investing, he worked at Motley Fool for 15 years or 20 years or whatever it is. These other guys, here's their background. This seems like it's a credible company. You have to do that homework. And that's true for everything. Let's pretend you're online. There's all these new digital first brands. If you've seen a TV commercial for Casper Mattress, that lets you know, okay, that's a real brand. But there's 17 other mattress brands that are also real and credible that you have to do that extra step of work from. But this goes doubly true if you're buying something like a cryptocurrency. And let me share it with all of you, people who are listening to the podcast. Unless you're a very sophisticated investor, don't buy cryptocurrency. That is a dangerous investment. I've sat with some of the smartest fools in the world who've tried to explain blockchain to me, and I don't understand it. That is a really bad investment choice, to put money into things you don't understand, as far as I'm concerned.
And when you say fools, you're not talking about foolish people. You're talking about that's how you all refer to yourself at the
Yes,
Motley Fool.
we're like the Smurfs. We use the capital F fool as how we
Smurfs.
refer to ourselves.
Okay, some of the people listening to this may not remember the Smurfs, but I certainly do. Dan, let's shift gears because we can probably talk about that on the network as well this coming Tuesday. I'm sure there'll be more information, but let's talk about the popularity of Zoom, and it seems that the people that created Zoom also have created a device, a more formal viewer that you can use instead of your PC. What can you tell us there?
Yeah, so this is a business device. This isn't meant for you and I to have a Zoom call catching up on our favorite baseball team. This is for an office that has, conference rooms, individual conference rooms, because it's really a one-person device.
Mm-hmm.
And it's the Rolls Royce of Zoom experiences. It gives you everything you need. It has multiple cameras. It's actually something that I'm thinking about because I broadcast over Zoom multiple hours per day. But it's a niche product. That said, this device is $600. It's not crazy to think they'll put out a $150 personal Zoom device that just makes it sort of like the Amazon Show. I have an Amazon Show. I bought it on Woot, which is an Amazon sort of discounter. I think I paid $40 for it. It's $150 regularly. And at some point, I'm going to buy my mom one because it's a really easy way to have a video conference without having to go through all the technical hoops of Zoom. Not that my mom doesn't know how to use Zoom. She does. But this is a really easy. It sits on my desk. I can use it right now to watch like music videos, or it has a screen so you can do some basic Amazon browsing, and that's where I think Zoom's going to go. This idea that there's this whole audience of people, and maybe you don't want to deal with getting out your laptop, logging in on the iPad. This is going to be a dedicated device, and the $600 one has multiple cameras. It's very optimized. So if you're someone who's, say, leading webinars, this would make sense.
Right.
If your office is regularly using these for professional-looking video conferences, it's probably better than what we do, where when we have an office, is 6 people are sitting in a conference room. I'm at home. My shot looks nothing like theirs. When they're talking, the person's always far away. This is going to give the ability to zoom in on the person talking, to do, to really optimize the Zoom experience. And look, we're entering a next level of video conferencing. It is already possible to put on, say, an Oculus Go and do a virtual reality video conference where you and I feel like we're in the same room. That's not practical because an Oculus Go is fairly heavy, or any of the Oculus devices. You probably wouldn't want to wear them for an hour-long meeting. But in the next generation of hardware, you're going to see slimmed-down headsets where that type of virtual meeting becomes maybe not common, but certainly not as bizarre as it would seem right now.
Yeah, I think so. Let's separate issues here. Number one, that device, $600. I think it's great that they came out with that. I think there is a need to improve the quality. I don't know if we need multiple angles of Jeff Snyder talking to Dan Klein, even though we get that on the network, right? But I think I don't know if that. I think the resolution. I think there's a couple things that make a video conference or a video very successful. The first is you got to have nice quality video, and you also have to have exceptional quality for audio. If you don't have good audio, it makes, even if you have great video, people will turn it off. Now, when it comes to Zoom, and you and I both attend a lot of webinars, we see a lot of things online, it's just boxes of heads, right? I mean,
Yeah.
it just looks like the Brady Bunch. And sometimes it almost mirrors the Brady Bunch with the boxes stacked on each other. So in my mind, we need to do a lot more, and this is what we strive for on the network, of including other visuals, graphics, and things. And I don't know if we're there yet on some of these technologies.
Yeah, I mean, Jeff, so I host a television-like program on Zoom every day at 4 o'clock. And we do the best we can using
Sure.
shared screens and visuals. But when you're looking at me, the viewer, what they see, they don't see the Brady Bunch boxes. They see the me in the big square. But it's one shot of me. And when I turn my head to read something on my second screen, you see the side of my head. If I was using the Zoom device, you would likely see me looking at the camera. So think of this for like the college professor teaching a class who's maybe setting this down and there's actually some movement, or the ESPN reporter who's using Zoom to dial in. I think they use Skype. I don't think they use Zoom, but the ESPN reporter who's doing that. This is going to enhance the broadcast element of Zoom, and that isn't entirely people who are doing a broadcast. I'm probably fairly unique in that, but like something like my mother's tap dance teacher who is using Zoom and just puts a laptop on the floor, and it's not a great way to do it. This could enhance all of those uses. And for businesses, look, my old yoga studio, West Hartford Yoga, has been doing, paid memberships yoga over Zoom. That's likely going to continue even when they go back to being able to use the studio, because members won't be able to get there. They'll have set up their home studios. There'll be all sorts of things that you'll be able to use this technology for. And look, as an investor, and I don't own Zoom, but I wish I did, this puts you in a scenario where Zoom is now a hardware company. And is this a very small niche? It's absolutely a very small niche. But could it be, the first of many devices or other Zoom? Look, could Zoom sell Zoom webcams that enhance the experience, Zoom microphones? That's one of the first questions people ask when they tune into our broadcasts at Motley Fool Live is, wow, your audio sounds so good. What headset are you using? And the answer is, I'm using like a mixer and it's like a $400 combination. That's not practical for most people, but certainly people could buy something, sold to them by Zoom in a $99 package. I think that's very likely.
Yeah, I think you're going to see people improve. There's a need to improve quality. Well, Dan, I'm looking forward to having you. I always appreciate you coming on the podcast, and I am looking forward to having you back on the network on Tuesday. So we'll talk to you then.
I'll see you then.
Take care. Welcome back. Now we're going to shift gears, talk social media. Joining me on the line, LinkedIn's Devin Banerjee. He's Senior Financial Services Editor there. Also the editor of the This Week in Finance newsletter, which you can find on the LinkedIn platform. Devin, great to talk to you for the second time today.
Absolutely, Jeff. Good to be with you.
Yeah, it's always great to talk to you. So a lot going on this week, obviously markets, finance. But what piqued your interest of all the stories that were trending this week?
Yeah, we had some really interesting conversations on the platform this week, Jeff. The first I'm going to talk about is, and this stemmed from an op-ed in the Financial Times, but it's related to what's called the Impact-Weighted Accounts Project at Harvard Business School. This is a project looking to reshape how companies are valued. So you think about today, you've got book value of equity on the balance sheet of a company. You've got attempts to determine the market value of a company with, discounted cash flow models, the present value of a company's future cash flows. This project at Harvard is attempting to create, like we have generally accepted accounting principles or GAAP, it's attempting to create generally accepted impact principles. So this is a way to take into account a company's environmental, social, governance impacts. And so this project is saying, look, you might look at the operations of two chemical companies, say let's take one chemical company, sales about $12 billion. What if you find that it actually creates environmental damage of $4 billion a year? You then, adjust your sales, adjust the value of a company by that amount. Or this project says, take Intel. It pays 50,000 U.S. employees $7 billion a year, so it's creating that positive employment impact. But if you look at its diversity and you weigh its diversity relative to the communities in which it operates, that actually might reduce the positive employment impact to about $2.5 billion from $7 billion. So a really interesting project. Now, of course, the conversation is just extremely passionate all across the spectrum. You have a lot of counter arguments here. You have people saying, of course, how do you measure these things? What kinds of metrics are we agreeing on? What kinds of data collection, principles and processes are we agreeing on? There are others who say, let's see some of these counter arguments here. They say, look, ESG proponents, say investors should pursue certain companies because of their positive impact, which would produce higher returns going forward. But if that wall of money, say $30 trillion today of ESG allocated capital flows into those companies, you're going to drive up the market value of those companies, diminishing future returns, right? Mm-hmm. We have others saying, look, what will the impact of this be on management teams and boards? And will you have companies straying from what they do best, the products and services that they produce and they're, specifically equipped and educated and experienced to produce, and you have them chasing impact? Well, that's going to diminish the value of those products and services in the future. And you'll actually end up with, companies that are trying to do good for society, but end up being just bad businesses. And then that's bad for both business and society and investors. So, clearly you can tell there are so many arguments on both sides of the spectrum, but this was one that really took off on our platform this week.
I would imagine it would, because ESG obviously been a topic that is not just a trend. It's something that we have covered on the network, and I think it's been around, being talked about actively. The assets in that space have picked up considerably. And then you have the Department of Labor issuing some new guidance around measuring ESG as it relates to ERISA retirement plans. So obviously this kind of stokes that debate. How do you measure things? And, arguably, every type of investment probably needs some level of measurement. I'm not in a position to, I'm not in the ESG industry, so I really don't understand all the data that is received, but certainly being able to provide more information about how a company does what it does, what the impact is, as long as I would just say to you, Devin, as long as it's transparent and people understand how you got from point A to point B, that seems to make sense. But I do think some level of quantitatively needs to be inserted in order to help better understand what people are doing. I mean, I think everyone would agree with that. But this is going to be iterative, I would imagine, like anything else.
Yeah, and I think those trends that you mentioned, which is the wall of money looking for ESG investments, as well as the whole bucket of retirement accounts and retirees considering this as well. I think that's really pushed. I mean that's had some positive benefits, getting companies to think about this, but it's also pushed the limits of how the lines are delineated, right? That you're starting to create buckets of whitelisted companies, blacklisted companies. Yeah. And so, a project like this is trying to say, look, let's apply these accounting principles, impact accounting principles across the board, across all companies, so that the comparison, so that it's orange to oranges and not apples to oranges anymore. So, I think everyone's trying to do the right thing and trying to standardize things and to take all of these important factors into account. But the way it gets done, I think, is going to be very, very a long road and a contentious one, to be honest.
Yeah, I think anytime you create something new, anytime you try to put like walls or barriers or new principles in, and you see this with, like, for example, pension GASB rules where, or you mentioned GAP. Those are things that are iterative and change, and they've evolved over time. So it's always messy. So that, in any new industry, and if Kevin Kelly, we're talking to later in the show, talking about cryptocurrency, that is another example of a new endeavor that requires probably some regulatory framework, but that requires understanding of what things are. So these things are always messy, and I think it's
absolutely,
it's part of capitalism and part of an economy, and that's how things work. If we had perfection, we probably all wouldn't be living in this universe or on planet Earth. That's for sure. So
that's right. That's right. Healthy debate is certainly healthy. One area, I know we just have a minute or two left, Jeff, but another area of healthy debate, which we went deep, you and I went deep on the network today, which is around diversity in the upper ranks of companies, especially the increase of chief diversity officer hiring we're seeing. We had an update to that story since you and I spoke, which is some new data around really linking diversity goals to CEO pay and how powerful that can be. So some recent data that we featured, only 78 of approximately 3,000 companies recently surveyed say that a portion of their CEO's pay is linked to accomplishing diversity objectives. And of course, the research is showing that when it is linked directly, then it is top of mind for CEOs. So this is a great story in the New York Times. Went into some examples of companies that are doing this. One of the most prominent ones is Microsoft, which I should say is my parent company at LinkedIn. But our CEO Satya Nadella has, I think, let's see, a good portion of his annual bonus is tied to diversity goals. Same with Uber, actually. Dara Khosrowshahi there. And that's a company that's really been under the microscope and spotlight for its lack of diversity in past years. For Dara Khosrowshahi, about a fourth of his performance-based stock awards are now tied to diversity goals. So this is a trend, I think, that will not be very contentious because it's something everyone wants to see more of.
Yeah, it sounds like, just going back to our previous conversation, right, with standards. If you're being evaluated, if you're a company being evaluated, one of the things they're probably going to look at is pay of management, right, and the makeup of management. So I would expect that these things would become under more scrutiny or more evaluation, maybe is the better word, and probably see more changes to align. One, you can't. We were talking on the program today at the network about. I brought up the comment about social washing or greenwashing, where you say you're going to do something and then you don't do it, right? That's just a lot of businesses do that, and I think this is kind of another example. I think, and I'm not saying they do it maliciously. I'm saying that they intend to do the right thing, but ultimately they may fall down because other things become priorities. And I think that this is an example that where the rubber meets the road. If you are for change and doing things within your organization, you will enact the protocols and procedures that allow you to get there. And one of those things may be adjusting your pay as a management team to ensure that you hit certain milestones. So I think that. Sorry, go ahead.
Yeah, no, absolutely. It's protocols, procedures, like you said, but now it's also metrics. And the great thing with these big public companies like Uber and Microsoft is they've got independent directors on the board. They've got a compensation committee, and so these metrics are now made public, and it's tied to, and the math of how it translates to these CEOs' bonuses is laid out. And so just to loop back on Satya Nadella, Microsoft CEO, I was looking for that figure. It's about 1/6 of his cash bonus. So not huge, but it's getting up there. And as I said, it's all laid out publicly now in the regulatory filings.
Oh, really interesting. Devin, always a pleasure talking to you. Twice in one day. It's even better. Have a great weekend, and we'll talk to you soon.
Sounds good, Jeff. Take care.
Bye-bye. Bye. Well, now time to talk markets, and joining me on the line is Kevin Kelly. He is the founder, or co-founder, I should say, of Delphi Digital, a cryptocurrency research firm. Kevin, great to talk with you. How are you this week?
Doing well, Jeff. How about yourself?
Doing great. A little cloudy today, but hopefully the weekend will be nice. Going to be making the trip to Baltimore to see my folks, or at least see them from 6 feet away with a mask on. But hope it's
Very
great.
nice.
Hope it's a great weekend. So, one of the great things I love talking to you and Oliver about is you guys can wear multiple hats and see it from so many different angles. So let's talk about the market this week. Give us some takeaways, things we should be thinking about with the markets and also economically.
Yeah, so you're starting to see again some of these trends we've been talking about start to play out within the markets. I mean, you still have the equity market, the S&P, largely, I mean, relatively, I guess you could say flat on the week, but still within 4 or 5% of its all-time high. And so right now, I mean, what it boils down for me, or what I'm watching at least, is the world is kind of one big macro trade right across different asset classes, and a lot of it's really being driven by the market expectations for future monetary and fiscal policy, both here in the U.S. and also abroad. So on the fiscal policy front, I mean, one of the things that's top of mind for us is looking at the unemployment benefits, the enhanced unemployment benefits that expire at the end of July here, and a handful of other programs, basically trying to see whether or not, and I would like to be proven wrong, but I don't think Congress is going to be able to pass something or get something approved before that expires at the end of this month. So we might have this few-week lag or lapse where that extra $600 a week going to people no longer does, and that I think will start to potentially weigh on asset prices if we don't see some type of proposal approved. But you do have, some, I guess you could say, relief type news. I mean, you've got, Mnuchin coming out and talking about potentially even forgiving pretty much all of these small business loans that they've given under a certain dollar amount, because that loan forgiveness process, or going through the paperwork of filing for a loan forgiveness program, is going to be complicated, and it's going to be tedious, and it quite honestly, it's just going to be inefficient. So, for me, it's still very similar to what we were looking at last week in terms of just that the current market construct is very much this kind of almost singular global macro trade, betting on, cheap money with rates staying low. The U.S. dollar has been relatively weak over the last couple of weeks, which has certainly alleviated some of the funding pressures on markets both here in the U.S. and abroad. But I do think that risks to this recovery are still certainly paramount.
Yeah, well, I mean, if you don't see that in the news, I mean, I don't even think you have to look at the markets, right? You can see small businesses shuttered again. I think I talked to Devin Banerjee this morning on the network, and I think over 110,000 small businesses potentially are closed permanently. And that is significant due to this resurgence of the COVID virus across many states. So there's a lot of unknowns here, Kevin, and it seemed to be logical to me based on the path that we have gone down, right? I think we talked about this last week. The path we went down with fiscal stimulus and other central bank efforts to help stimulate the economy, keep it going. I would expect that the expectations will remain. So I guess whether or not we get another round of stimulus before or after things kind of expire, I guess is really up to the people that in Washington, D.C., right? At the end of the day.
Yeah, and we put out a note earlier this week, basically just called the incoming stimulus cliff, and it's looking at exactly that, to your point. And when you look at it, I mean, it's tough to nail down exactly how many small businesses have actually closed up shop permanently, right? And the numbers that I'm sure you and Devin were talking about, I think it was from a Harvard Business Review or some type of Harvard study, right? And so the numbers are anywhere between 60,000 to 110,000, which is obviously a pretty staggering number.
Yep.
But one of the really interesting stats that came out this week was Goldman had a new survey across they surveyed some of the PP loan recipients with some of their clients. And 84% of those that they surveyed said that they'll exhaust their funding by the first week of August, right? And so when you think about that timeline, right, and again, it's middle of July. I mean, we're coming up, first week of August is 2-3 weeks away. The fact that you have such a large percentage of those small businesses that are still afloat technically, but are very, very heavily reliant on more stimulus and basically more money coming into their companies or their small businesses, that means that the pressure on policymakers is immense. And I don't think we can really understate that, because a lot of the current market construct, again, is built upon this idea that we're going to have this large monetary and fiscal stimulus backdrop. And the moment that you start to either remove that or even signal that there's going to be less accommodative policy than the market expects, that could certainly weigh on asset prices here.
Yeah, I think you're right. I mean, like I said, we're down this road. We decided to go down this road. People can debate right or wrong or in the middle, but there's expectations there that have to be met. And if not, especially when you have a resurgence of a virus, when you don't have a vaccine, there's that expectation. Kevin, I want to shift gears, talk a little cryptocurrency. What's top of mind this week when it comes to digital assets? How have they responded during the week?
Yeah, I mean, you've still got a pretty sizable bifurcation between Bitcoin and then we'll call the rest of the crypto asset market. Bitcoin has been stuck in this consolidation pattern, this range for the better part of 2 months now at this point. Trading now between 91 and $9,200. And so for me, I mean, on the macro front, a lot of it ties back. Bitcoin's volatility has fallen to levels in which previously you would expect some type of big move to come because volatility levels have been relatively low compared to historical averages. So what we're expecting is some type of big move here. I think the timing of that could actually line up incredibly well with what we were just talking about on the policy front. Mm-hmm. And so, in scenario A, if we do see a large, stimulus package get passed and approved, and it's larger than, again, what the market expects because markets are discounting mechanisms, if it is a large package, you could certainly see if risk assets run up and volatility continues to come down a bit in the equity markets, that could certainly be bullish for Bitcoin in the short term because, again, it has been trading more in line with equities than it has with gold. On the flip side, if you see some of that stimulus kind of get pared back, I mean, the short-term drivers or biggest catalysts, at least in our view, of Bitcoin versus even risk assets are largely similar, right? It's a bet on more expansionary monetary and fiscal policy, and so if you don't get that, certainly could be a headwind for Bitcoin at least in the short term. But I mean, the long-term thesis certainly still stands. Across the broader crypto market, I mean, you are starting to see some really interesting price action around different sectors of this space that are starting to trade more in line with peer tokens or peer coins, I guess you could say. And that's an interesting kind of change from what you've seen historically, because largely, I mean, a large part of the crypto market is still very much correlated to itself, right? Or there's a high correlation across different crypto assets, but you're starting to see those correlations break down across different sectors, which to me shows that there is at least a bit of maturation of this space, and there's a bit more, I'll say, fundamental type analysis going into this. To say that there's not a lot of speculation still would be a lie, but at the same time, there are people that are pushing or pushing capital into certain parts of this market that fundamentally could make more sense than others, if that makes sense. You are starting to see a bit more discipline, I guess you could say, on the crypto investing front.
Yeah, I was going to ask you what the flows look like. I mean, we often get flow numbers. They're published from the Investment Company Institute, tells us about mutual fund flows. We also see things with hedge funds, private equity. What are the general? Do you get flow information? Published flow information?
Yeah, no, it's a great question. So one of the interesting ways in which this market has transitioned to, that's important to point out is, is 12 to 18 months ago, a big gateway into crypto was people buying Bitcoin, right? Because once you bought Bitcoin, you could go onto these other exchanges, you could buy these different, alternative crypto assets, some of these other digital assets, but you kind of had to hold Bitcoin, or at least that was kind of your gateway into it. Now you've had the emergence of all these stable coins that we've talked about in the past. You can go onto Coinbase and do basically a dollar swap for a stable coin that's on there. So you don't necessarily have to go through Bitcoin itself to get into these other assets. And so it makes tracking some of that flow information a bit difficult because obviously some of these exchanges keep some of that information pretty close to the chest. But we do track things like on-chain exchange flows and things of that nature. And what we've actually seen over the last couple of months here, in our view, is long-term bullish, because you're actually seeing people take Bitcoin off exchanges, which you would interpret as them putting that in cold storage or them holding on to that for the long term, right? So you have a lot of people that are betting on the long-term price appreciation, or at least saving mechanism that Bitcoin can be, which again, in the short term, anybody knows where the price goes, but it is, kind of supportive of that long-term bull thesis.
Yeah, really interesting. Really fascinating. Always interesting to watch a new asset class get created and grow and see it continue to evolve. Kevin, always a pleasure chatting with you. Thanks so much for joining us on the program, and we'll chat with you again next week.
Yeah. Sounds good, Jeff. Have a good one.
Bye-bye.
Yeah. 1, 1, 2.
But now we're going to move on to real estate. Joining me on the line from Dow Jones Market Watch, Mr. Jacob Hesse. Hey, Jacob, how are you? How was your week?
It's been good. It's been good. How are you?
I'm doing quite well. It's a little cloudy today, but hopefully the weekend turns out to be a lot nicer and warmer and no rain. But I'm doing well otherwise. So let's jump in. Obviously, a lot going on in the markets, a lot going on in technology. Nothing different for real estate, I would presume. What's top of mind for you this week?
Yeah. So first off, you and I talk all the time about mortgage rates. So there was a big landmark that kind of came this week. So Freddie Mac releases its weekly mortgage rates report, and this was the first time in history that the average rate for the 30-year fixed-rate mortgage dropped below 3%. So currently, the average rate on a 30-year home loan is 2.98%, which is quite a big deal. Back when the pandemic first began, I actually spoke with the CEO of Quicken Loans, who at that time, told me he couldn't envision the 30-year rate dropping below 3%, and now here we are. So kind of a remarkable turn of events over the past few months, and just really shows, how much of an effect the pandemic has had on the mortgage market. Mm-hmm. And interestingly, economists, believe that low rates are here to stay, and they may drop even lower, which is kind of hard to imagine given how low they already are. But, reports from Fannie Mae, Realtor.com suggest that the average rate will remain below 3% in 2021 for the 30-year fixed-rate mortgage. So, that kind of just shows that this is a bit of the new normal, at least for the foreseeable future, unless things really, change remarkably with the pandemic.
So what does this mean, Jacob? I mean, just to kind of bring it in the context for the audience and even for me to understand, we have the fixed 30-year fixed rate mortgage. Most mortgage terms, I would assume, are 30 years generally, right? And so what you're saying is the cost to borrow now has dropped below 3%, meaning the interest rate has dropped below 3%. Is that right?
Yeah. So the 30-year mortgage is definitely, the most popular home loan in the U.S. Obviously, there are folks who get 15-year mortgages, and those usually have even lower rates than they still do currently. So, if you get a shorter term of a rate, for your mortgage, whether it's 20 years, 15 years, 10 years, your rate might be actually substantially lower. And to be sure, folks have seen rates below 3% before on an individual basis, but this just is kind of showing the movement of the market overall. So Freddie Mac's report looks at conventional home loans, which are home loans that can be purchased by Fannie Mae or Freddie Mac. The rates on FHA loans tend to be a little higher. So that sector of the market, isn't necessarily seeing sub 3% rates at the same level as, folks getting into Freddie Mac, Fannie Mae loans. Mm-hmm. And the other important thing to note, which economists told me, was, not everyone has access to these loans, even in the pool of folks who can get home loans from Fannie Mae and Freddie Mac. Right. Mortgage lenders have tightened their lending standards quite a bit. You have to have higher credit scores to qualify, more of a down payment, et cetera. They're really keying in on your employment history because obviously lots of folks right now are laid off or furloughed. So all those factors go into their decision making. So you have to really have a really stellar credit profile to be able to qualify for these really low rates, and a lot of folks aren't. And there's a really wide spread in the market right now, actually. So the average just means when you add all of the numbers up, that's the average. It doesn't mean that is like what everyone's going to get. So certainly there are folks getting above that, and there are certainly folks getting much lower than that. The other interesting effect of all this, though, is there are concerns that the low rate environment could, in the long term, cause issues for the home buying market. And the reason for that is, folks right now who are refinancing into, mortgages with interest rates below 3%, or folks buying a home with mortgages with interest rates below 3%, those people are probably going to be hard-pressed to move to a new home if rates rise significantly from where we are now. So, let's say we get back to a world somehow where interest rates are at 5%, 6%, 7%, like they were, before the, housing crisis in 2008. I mean, for folks who are first-time home buyers, this might feel normal, this low of a rate in a way. But, obviously in the long history of the mortgage industry, rates used to be much higher, above 10%, even 20%, They used to be much higher. So let's say rates rise significantly. Well, then there's going to be a whole population of people for whom buying a new home will be that much more expensive once they're, factoring in the financing that they already have for their current home. And right now we already have a situation where the supply of homes for sale is extremely constrained, which is an issue the industry has been facing for a number of years now. And that's why home prices keep rising, et cetera. So this could, end up exacerbating the affordability issue, weirdly enough, in the long term, because it'll, keep people from selling their homes and, restrict what homes are available for, years to come, potentially. So that's just kind of an interesting corollary to, the downside to what is, pretty good news that interest rates are so low right now.
Yeah, I think it's interesting, and thanks for breaking that down. I think it is interesting, and as you and I have talked over the successive weeks about the things you just outlined, the market, the availability of homes, it just shows kind of the tightening in some areas. And even if you wanted to buy a property at a low rate, first of all, you have to be able to find something in order to buy. Jacob, last question. I mean, do you think that you would see more people refinance now? Are people going to be, because I think it was before COVID, the pandemic, there were lower rates and people were refinancing. And I think right as the pandemic hit, before the pandemic hit, there was some restaffing up to deal with those, more application submissions. Do you think that more people will, seeing lower rates, will decide to refinance their mortgage or change their mortgage longer term?
Yeah, so, like you just said, right at the beginning of the pandemic when interest rates hit, this year so far, interest rates have dropped to record lows 7 times, which is quite remarkable.
Yeah,
so the first time that happened was back in March. And when it happened, there was a massive surge, like you just described, of refinance applications. Where we are right now, refinance activity is still very elevated compared to a year ago, but it's down from where we were back in March. Mm-hmm. And folks who refinanced in March have no reason to refinance again now. Rates haven't dropped substantially enough from where they were in March or, earlier this year for it to be worthwhile. You basically want to target, you have to do kind of the calculation on your own, but, basically you want to make sure that you break even within a few years for it to be worthwhile. And then you also need to keep in mind, if you are planning on moving or anything like that, it doesn't necessarily make sense to refinance. If you're moving in a couple years, if you, are in your starter home and know that you want to have kids and probably get, a larger home with some extra bedrooms in a 5-6 years, the cost of refinancing may not be worth what you would save because those savings come over the lifetime of the loan. So, those are factors people need to consider. But, certainly refinancing activity is elevated right now. And that's the other reason why lenders have some, reason to continue dropping rates is because for a lot of lenders, refinancing makes up a significant portion of their lending activity. And, refinance loans are cheaper to do because oftentimes, the borrowers have already been approved for a mortgage. Most times they've already been approved for a mortgage. So you kind of know they're already creditworthy. If you're already their existing lender or servicer, you kind of already have a picture into their finances and know how often they're making payments and things like that, which make it easier to, do the underwriting and whatnot. There are fewer requirements from, the regulators for refinance applications. So lenders certainly want that, gravy train to keep on running, and they will, keep rates competitive for a while probably to do so.
Certainly very interesting, and it's just a sign of the times. I mean, it's adapting and changing, ebbing and flowing, and I think I'm glad that you're here to kind of bring us the news. Jacob, always a pleasure chatting with you. Have a great, wonderful rest of the weekend, and we will talk to you again next week.
Yeah, talk next week. Take care.
Bye-bye.
Bye.
One, two, bring it to the four.
Welcome back, and now we're going to talk about. Sorry, let me do that again. 3, 2, 1. Nice, right? 3, 2, 1. Welcome back, and we're going to continue our conversation on markets. Joining me is the lead anchor for the TD Ameritrade Network, Mr. Oliver Rennick. Hey, Oliver, how are you?
Hey, Jeff. Doing good. Thanks for having me as always.
It's great chatting with you, and I thought what would be interesting for the audience is a lot of great stuff that each and every week that the TD Ameritrade Network is covering. You guys have it down in terms like a science in terms of the great stories and great guests. But what are some of the stories? We're talking on a Friday afternoon, Eastern time and Chicago time as well. And what are some of the big storylines or things that you saw develop over the course of the week?
It was a pretty exciting week. I'm kind of glad you phrased it this way because we were really kind of highlighting the way we think about markets over the past week. We, as you know, don't do politics. We don't do drama. We don't do sensationalism. We're just buried in the market all the time. And by virtue of that, just a lot of times we just frankly notice things before others do from a media standpoint. And the last week has been a pretty good example of this. On a Friday last week, so about a week from today, the coverage in our afternoon show was centered on a series of events in the market that I found to be really interesting and unique at the time. And that was 1 week ago today, this rotation happening in the market that didn't seem to go along with the common narrative of vaccines rising, states under pressure with restrictions rising again. And what we actually saw was a kind of characteristic rotation in the market that was led by companies that depend on the economy reopening and looked a lot like a specific day from the recovery, May 15th, in which the market did something similar, where in the middle of the day it kind of pivoted toward banks and pivoted towards small caps and kind of showed this optimism in the economy. And then over the next month, we had a really big push that brought us to new highs in the recovery, brought us to a record in the NASDAQ, but really it was about this reopening trade that developed in the market. So at the time, I'm not really trying to fit a narrative to it, just said, hey, this is what's happening, and we don't really know why. It doesn't necessarily make a ton of sense with the problems we're having with containing the virus in a lot of these areas. But it did happen. So, from a kind of technical analyst perspective, you just observe events and you try not to work against the market and try not to basically, push your own narrative, right? And we never do that. So my point was, look, I don't know why this is happening, but it's happening. So this week, this entire thing basically played out. And it's pretty amazing to watch because then this was the talk of the entire market the last 5 days. And frankly, we were 3 days ahead of it because it's just when you're buried in the market, not worried, about covering the latest poll or, the drama over who says what about a mask or something. It's just you kind of are able to isolate these things more specifically. And that's really been the story this week, which is, is this market rotation that's happening out of the tech stuff into economically sensitive groups, is it really a sign that the economy is improving, or is it just kind of like this, slow bleed out of the strength in the market, and the NASDAQ's just the first to go? So that's really the big question right now.
And did you get any type of consensus from guests this week when you were chatting with people? Because you have a range of guests. You have the analysts, you have chief executive officers, you've got all gamuts, right? I mean, did you get any type of consensus, or is it just everybody? It's kind of a free-for-all. We just don't know, right? I mean, it's a very fluid situation.
It was, I think, surprising to a lot of people to see what's happening underneath the surface of the market. And I got to say, there's not a ton of believers of it. Most from the investment side are still largely into the NASDAQ growth, tech companies, not quite ready to buy into this pivot, and it does need to have, I think, a good bit of justification economically to continue. So, it's definitely caught people's minds. The small cap managers and stuff love this, and the value managers really like it because it does seem like there's a pretty good setup for this type of lasting move and rotation, but it's really just going to depend on how steadily the economy can continue to reopen, and that's obviously a very difficult question to answer right now.
Yeah, but it's certainly refreshing that you just look at the numbers, right? The numbers kind of weave a story to you and the team every week, and that's what you pay attention to. As you said, you're not worried about some of the other, what I would consider to be extraneous noise, though sometimes the markets kind of listen to that stuff, right? But I mean, you
Sure.
do your best to kind of wall it off and just say what are these numbers telling us, and let's get some stories up on the network to kind of help explain what's going on.
Yeah, exactly. Last Friday was just like, it was strange because I was actually on my Twitter, I screen grabbed like the top headlines from Bloomberg, and they were all so negative, and just really bearish overall and kind of pessimistic. And it just was like, hey, these are the headlines, but this is what the market's doing. And generally, I'm just always going to go with the market. It's not my job to try and guess what's going to happen or impose a interpretation of what's happening. It's more just covering what's happening and doing that as specifically as possible. Sometimes in your understanding of what's happening, you get better insight into what could happen. And then you can kind of start to, think about that, but it's not the place to start from. You start with what's happening and being able to describe it. And so this week, that stuff continued to happen, and it's pretty interesting. It's pretty exciting if it's for real, and I generally think it tends to be where the market probably has, the neural net of everybody investing, trading, trying to figure out what's going on, probably has a pretty good grasp of the likelihoods that our economy continues to improve, and it seems like right now the market is voting in that direction.
Yeah, well, one of the last bastions of objectivity, Oliver Rennick and the TD Ameritrade Network. Always a pleasure. A little bit tongue in cheek because there are obviously others who do that, but always a pleasure chatting with you.
Yeah,
and have
you.
a great weekend, and we'll talk to you again very soon. Welcome back. Now time to shift gears, talk a little healthcare. Joining us on the line, she is the healthcare editor for Business Insider, Ms. Lydia Ramsey. Hey, Lydia, how are you?
I'm good.
It's great to talk with you. Hope you had a great week. I know you were off the last few Fridays, so glad you got some rest and relaxation. But a lot going on. And I should also add that you are also the editor of Dispense, which is a newsletter focused on the healthcare sector that you and the team do each and every week. But I want to check in. What's top of mind this week? I would assume there's a lot going on in healthcare with vaccines and just the normal parts of business.
Yeah, for sure. Yeah, it's seeming like July is going to be a really busy month for learning a lot more about vaccines. On Tuesday we got the official published results from Moderna's vaccine effort. So that was cool to see, what's at play, what's the immune response, what's happening there. So it was positive, and it was good to see. It's good to have in advance of them starting a really big 30,000 person trial later this month. We're also expecting to see some data coming out of the University of Oxford vaccine effort. That should be coming out on next Monday, so that should have to tune into that and see how it looks. So a lot happening there. A lot happening. One of the areas I'm really closely focused on is the new ways people are going to the doctor. And one of those parts of those themes is primary care and what's going on. So this past Friday, Oak Street Health, which is a primary care operator based in the Chicago area, they are backed by private equity firms like General Atlantic, and they filed to go public. So they're going to join One Medical as a publicly traded company in primary care, which is still a new idea. So it's been interesting to look through their filings, get a sense of, how they're making money. It's a lot of taking on the risk of Medicare patients, which is, still a relatively new idea. But it seems to be one that can make a lot of money compared to, the traditional kind of pay based on how many visits you're conducting, that fee-for-service model. So it'll be interesting to see how investors respond to them going public.
And when does the IPO actually happen? I mean, it will happen in the fall. Will it happen next week? I mean, what's the timeline for that? Did they give any indication?
Usually IPOs take about 3 or 4 weeks from when they file their S1, that first initial paperwork. Once that flips, then they have a little bit of a roadshow, which is probably a much different experience now that everyone's remote.
Yep.
So I'd expect it in the next month for sure.
And then when it comes to the vaccine, Moderna, releases some testing results, look positive. We're expecting the Oxford results and some others, and they're going to do a much larger study. This is still ahead of the traditional timeline, right? I mean, just to kind of give people perspective. I mean, to go develop a vaccine usually takes months and years, and this has all been very accelerated.
Absolutely, yeah. It's something Merck's CEO was talking about it. Merck's a prolific vaccine maker that made a lot of the vaccines that have been approved, and he was even, Merck's CEO was even throwing some cold water on it, saying like, this is pretty unprecedented how fast things are moving. But it's on one side, everyone wants to keep their hopes up, right? Like, having a vaccine would change the way we're living our day-to-day lives right now. But, there's still a lot of room for error. And when you're moving this fast, it doesn't mean we're always going to be moving this fast. Maybe at some point we'll have to slow down and take a step back and kind of, take a little bit more time in this drug development process. So we're still not there yet.
No, I mean, I don't want to give false expectations, but I mean, it's obviously a good sign. And with the recent reclosures in some cities and towns and states, some businesses are shuttered again. People have to stay home. We should always be wearing our masks, protect spread. But this kind of gives some hope that we will return to some level of normalcy. Is it, with all these other companies, I mean, I guess it's kind of a race to find the vaccine, right? Because if you find the vaccine, I mean, you kind of pretty much plant the stake in the ground. You're first to market. That's probably good from a bottom line perspective. But would you expect that if a vaccine was found that other companies would share in the production? Because how could you turn around the volumes and volumes of the amount of vaccine that you would need?
Yeah, I think it's a big manufacturing and distributing this is going to be a huge question mark. I think we've seen a lot of announcements around, companies partnering and companies building up capacity. I think Moderna's got its own deal to help with manufacturing. To your point, like, I think there's going to be a winner in the sense that someone's going to make it to market first, and that's going to be a really big deal for their company stock price. It's going to be a really big deal in medicine and getting this to the right people. But there's going to be room for a lot of vaccines on the market. If everyone needs to be vaccinated, there's room for a lot of people to play that role. So it'll be definitely a challenge to see, what that looks like. If I'm presented with 4 options of a vaccine, how do I make the decision about which one's the best one to take? Is it something that one will emerge as having a much higher protective percentage? Maybe they own, like, it's 70% effective versus the other vaccine that's 50% effective.
Yeah.
There's a lot of that will need to get worked out over the next, larger trials.
Right. I would assume that if you had a longer period of time to do the testing, one would certainly win out over the other one, and you would have more indication of results. It seems like just with the expeditious nature of this, obviously that some of that can't be fleshed out. Question for you that I read in Dispensed. Lydia, I know data is really very important to all the key decisions being made by the CDC and the other departments, the administration. Recently, some of that data may have been taken down or put somewhere else. What can you tell us there? Because I think obviously data is the center point of everything that we're hearing day to day about this virus.
Yeah, absolutely. So this week, the Department of Health and Human Services said they were going to start sending hospital capacity data. So that's information on beds and supplies and staff. that we really need to know to understand, where are places getting overwhelmed by the pandemic. They said that they wanted to send that information, it was going directly to the CDC, but now it's going directly to HHS to go into a data project called HHS Protect. And it's raised a lot of eyebrows because that project has been working with a lot of outside contractors. That includes folks like tech company Palantir, and so that's raised a lot of eyebrows as to where that data is going, how it's being used. Will it become more transparent, less transparent? Right now, it seems like it's a much less transparent process. We're seeing, we had this database or this information kind of going straight to the CDC website, and you could track, like you and I could track where hospitals were getting overwhelmed. And now that data's been pulled down. And maybe it'll come back someday, but for now it's kind of a little bit cause for concern, but we'll see.
Yeah, I mean, so much for government transparency. I mean, I don't understand why that would be so harmful to keep out there. Well, I guess more to come on that. But good news on the vaccine front. Really great to hear it, and good news on IPOs happening. That's always a good sign as well. Lydia, always a pleasure chatting with you. Appreciate the opportunity to catch up, and I look forward to talking with you very soon. And enjoy the rest of your weekend.
Yeah.
Awesome. You too.
Bye-bye.
Bye.
Yeah. One, two, bring it to the phone.
Now time to talk retirement. Joining me on the line, Dow Jones Market Watch retirement reporter, Alessandra Melito. Allie, how are you?
I'm good. How are you?
Doing well. It's been another great week. Lots going on in the market. Lots going on in retirement. But now we're talking retirement. I want to get your feedback. What's top of mind for you and the folks at Market Watch this week?
Yeah, so a few surveys came out this week about retirement security and how Americans are feeling these days. One stood out to me because it said that more Americans are concerned today about retirement than they were even just a few months ago. And I think that makes a lot of sense considering the global pandemic that we're in the middle of and the fact that there's so much uncertainty about what the future holds, at least in the near term, but also, of course, the effects of today on, the longer term picture. Mm-hmm. So there are 62% of Americans that say they're more concerned about retirement today than they were in May, when that figure was about 56%, according to a financial technology firm survey. The firm is called Simply Wise. And they just try to take a pulse of just retirement confidence and security. Most of the people who were concerned were those who were closer to retirement, such as those in their 50s. But overall, they found that lots of people see that their current finances are suffering, and it's taking a toll on their savings or their ability to save. In another survey I wrote about, it was good news. It found that even though people are concerned about their finances, not that many people are tapping into their retirement accounts yet, even though the CARES Act allowed, that the expansion of withdrawals or loans from your 401k or IRA. Mm-hmm. But at the same time, it's still rocky for a lot of people. And that it will only affect not only their future retirement security, but even like how they claim Social Security, or take on a new job or rebuild that nest egg if they had to pause their savings or their contributions and so on. So, it's still too early to tell what the total impact will be on retirement security, but as of right now, it's a little concerning.
Yeah, I would say, I mean, just anecdotally, I didn't necessarily look at the data behind the surveys. I mean, we during the day, who has time to look at every possible story? Although I certainly try. Anecdotally, I would say that the fluidity of the situation probably lends itself to how people are feeling. So people can be bullish when things are going well, and then when things tend to drop off again, whether you have a surge in coronavirus cases, you have a surge in unemployment continue, you don't see job creation, that probably drives people's different opinions, and whether or not they're in an employer-based retirement plan or they're just saving to an IRA or they have no retirement prospects at all, that probably is a lot of what what shapes their opinions, I would think.
Yeah, absolutely. And also their plans or, their intentions for the next 3 years. So some people said, well, they're concerned about their retirement in the future. So as a result, they're going to prolong their career.
Mm-hmm.
And, that's definitely one option, but it's not available to everyone. And the problem is not everybody knows it's not a problem to everyone until you get closer to retirement and realize that you can't prolong your career. And there are a few reasons why that is. Sometimes it just has to do with, the job market. If, like as we're seeing right now, people are restricting hiring or they're laying people off. So that would, of course, be detrimental to somebody who figures that they're going to prolong their career and build up their nest egg for retirement. Other people, they are in physically demanding jobs, and as they get older, they're maybe not able to meet those sorts of demands or those types of responsibilities. And, that's not a fault of their own. It's just, it's just something that happens, unfortunately. So, and then, of course, there are other things that, people have to take into consideration also, like unexpected emergencies, such as an illness or injury. We're seeing a lot of that nowadays with the COVID-19. I don't think anybody saw this coming. And it's playing a role in how people are even planning their retirement in the next couple of years, not decades. So, there are lots of ways that people can approach retirement security, but I think 2020 has taught us that, you just have to buckle down and do the best that you can so that you're always going to be concerned about your finances, I think, in the middle of a pandemic. But at least you'll be able to have some sort of sense of comfort if you have everything in the financial picture that you're able to look at for your own personal needs.
Yeah, I guess it just comes down to you control what you can control, and circumstances will dictate ultimately what you can and can't do. And you hinted at some challenges for older workers or individuals trying to get back to work, and that certainly is probably more of a challenge than ever given the circumstances. But one thing I have read is that gig workers are seeing a resurgence in opportunities. So those that are contractors, because as you indicated, a lot of companies they would put a hiring freeze. They don't want to hire someone long term, but they're happy to take on consultants for little projects, and so that could be an opportunity. So maybe you can't extend your career at age 62 to maybe working at age 67 because someone's not hiring full time, but you can maybe reskill or take on a contract position maybe that has limited benefits.
Yeah, and that's something a lot of people, even already in retirement, are doing to supplement their retirement income. Maybe they have enough in their 401k and they get a pension if they're lucky, or they're claiming Social Security, but they're using gig work as a way to add an extra cushion to what they see every month in retirement. And other people, of course, use gig work not only to pay their current bills and put food on the table, but to supplement their retirement savings, that way, so that when they do get to retirement, they have more than they would have had they not had that extra job. Of course, that's also not possible for everybody. There's so many responsibilities everybody has, but it is definitely, like you said, an option these days.
Yeah, absolutely. Well, Allie, it's always a pleasure chatting with you. Certainly a lot for people to think about. Always interested in reading the studies, learning more about what people are thinking. And at the end of the day, it is a individual, in preparation is really up to the individual. So it's obviously better to start early. But, everyone has their circumstances to deal with. Great talking with you. Enjoy your weekend, and we will talk to you again very soon.
Yeah.
Great. Talk to you soon.
Bye-bye.
Bye.
Well, that wraps up this episode of the BRN Sunday podcast. I want to thank all of our great contributors for their excellent insights and analysis. And I want to thank you, our audience. Hope you found the content educational and entertaining all at the same time. We're back again tomorrow morning on BRN AM. I'll be joined by DeCia executive member Melissa Kahn. She's also managing director of State Street Global Advisors. So until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Perfection is perfected, so I'm a lad, I'm understanding from a young G's perspective.